Hello everyone, can everyone hear me well? So can you just say yes or no in the question in the questions box? So can you send me just a comment that you can actually hear me well or not? I would deeply appreciate that. I presume that you're listening to me, right? And the video is good. So okay, excellent. Thank you, Evantus. So let's start our webinar. Welcome to our webinar today. As you know that if you have any audio or visual issues, given that we've just heard that some people at least can't hear me well, so please check the settings on your computer. Let us know if anything happens and you cannot hear as well. And if you have any questions that would require longer explanations, please send us an email directly to webinars@hotforex.com, and either myself, Andrew, or Stuart will come back to you. In the meantime, please feel free to interrupt me and ask whatever questions you may have on this topic, and I will please send them over, and I will answer them directly. So a little bit about myself. So I am an economist. I have more than 4 years of experience at the Central Bank of Cyprus and the overall Euro system of central banks, where I have obtained hands-on real-life experience of about how economics works and what makes policymakers change their minds and their decisions. I am really a supporter of a balanced approach between science and art when it comes to spotting trading opportunities. And what I mean by that is that I am an advocate of both a scientific as well as an intuitive method of understanding how the market should evolve. I also hold a PhD in financial economics, and my research has gone through various topics and published in various journals, mostly related to trade balance, macro developments, and other various topics on economic policy. Please remember that this material is provided as a general marketing communication and does not constitute independent investment research. So nothing in this communication contains or should be considered as investment advice or any investment recommendation for that matter. So please keep that in mind as we go on. So what we're going to cover today in our webinar is really what the trade we're going to go through what the trade balance is. We're going to see what the trade balance forecast can do for the currency markets. We're going to go through a real-time example, and we're going to examine whether the trade deficit is bad for everyone, for example. This will come clearer after our first session. So we'll have again a Q&A section, which should in which you can post any questions you have on the topics covered. So again, as I've said, please feel welcome to submit any questions at any point in time. So, what is a trade balance? Remember that trade in general is a very important determinant of exchange rate behavior according to economic theory. So the idea is quite simple. Trade, as you know, means that I get some goods from somewhere, I transfer them to another place, and through that I obtain some either better quality goods or better priced goods. For example, if the same pen is worth $1 in the United States, but I can import it from, say, Germany at a total cost of 80 cents of the dollar, then I would get the same good at a lower price. Similarly, if, for example, a computer is much better in the United States than in Germany, a German can import the computer from the United States and get a better quality product. So how does this work in economic terms? So the rationale is very simple. So if you're buying local products, then the foreigners is essentially offering their currency in exchange for the domestic one. What I mean by that is that, for example, in the case where a person in the United States wishes to buy something from Europe, then he would essentially say that, well, I'm offering this dollar in exchange for the value for that good, and hence I need to transfer that dollar in euros. So the idea is that we need to move to exchange the currency in the local market currency, for which in our case is Europe. A similar example is follows just below. So suppose a European wants to buy a Japanese car. So what happens is, say that the car is worth 50,000 euros, then the European person needs to give those 15,000 euros in exchange for some yen, through which he will be able to pay the Japanese person that amount of money. In essence, what we're saying is that the quantity of euros in the international market following this trade transaction should increase. How much should it increase? By exactly 15,000 euros. So what we're saying really is that if say, for example, 1 million euros was held by foreigners, now foreigners will own 1,015,000 euros due to this exchange. What this means is that the supply of euros has increased in the market. So remember that demand is how many people want to get our currency, and supply is how much of our currency exists in the market. So the idea is that this holds if we maintain this change in the quantity of euros. So what does a change in supply mean? A change in the supply means that the exchange rate needs to fall. Remember that we have supply and demand in economics. So in economics, supply and demand determine the price. In this case, we have supply for the currency, which is, as we've said, the money, the available money, say, for example, for the euro. And we have the demand for euro. So how many people want to get that euro to conduct their transactions. So this means that an increase in supply suggests that more euros exist in the world economy than the existing demand. What this means is that as more euros exist and less people want to use them, then it means that the price of the euros is going to go down because less people want to actually use these things. In this point, the price of euros is really the exchange rate. So in the case that a European wants to get a Japanese car and has to offer euros in exchange for yen, it means that he, at the same time, increases the supply of euros and increases the demand for yen. So what this means is that the euro-yen exchange rate should rise. Hope this is clear. If you have any questions, please let me know. So what happened in this case is that, as we've said, the euro will depreciate and the yen will appreciate. So in general, the trade balance shows exactly this thing: how much the country has sold abroad and how much it has actually purchased from abroad. So, for example, if I'm selling, suppose an economy just sells and purchases cars. In this case, if it sells more cars than it has imported, then the country's trade balance would be positive. So more money has come into the country than has exited the country. On the opposite side, if that country sells less cars than it has bought, then this means that the trade balance is negative, so it has a deficit, as is the proper term, and this means that there is more supply of the currency than before. In the previous example where we had the surplus, what this meant was that the country would have less money available for outsiders than it used to have before. So, for example, if it buys less from abroad than it sells, then this means that the prices will evolve as the exchange rate will evolve as we have talked before. So this is a more general term. For example, suppose that instead of having just cars, suppose that we have a country that is a modern economy, for example. It imports cars, other vehicles, food, other types of services, or even computer equipment and stuff like that. So suppose a full economy exists now. What we will see is that if a country sells more goods and services than it has purchased, then again, this means that the country has a trade surplus. Again, a trade surplus means that this country has decreased the supply of goods of its own currency, and hence we should observe an improvement in the exchange rate. In contrast, when there is a trade deficit, which means that the country has imported more than it has exported, then we have an increase in the supply of the currency, which should depreciate the exchange rate. So this is what we were discussing. For example, a positive trade balance again signals that the country's currency should strengthen. In contrast, a negative trade balance, i.e. a deficit, suggests that more supply of the currency exists than there is demand. So we expect a potential weakening of the currency. Notice something important here, that the larger the deficit or the larger the surplus, the larger the move in the exchange rate due to the larger change in supply. So, for example, a country which has only, say, for example, 1% of GDP deficit will see a much less depreciation of its exchange rate than a country that has a 10% of its GDP as a deficit. So let's see now how we go to the trade balance. So what we see is that the trade balance is quite important. I think we have acknowledged that. Given that this is quite important, our experts, not just trade experts, not just HotForex experts, but in general, economic analysts, aim to provide a forecast on its future values. So, for example, if we go to the economic calendar, like here in this case, we can see that there is a forecast right here for the Australian trade balance, which is coming up on Thursday. So what this suggests is that the trade balance previously stood at 1.5 billion, that is 1,551 million Australian dollars, while in this this month we expect, basically consensus forecasts expect, that the trade balance should deteriorate. So i.e. the trade balance should worsen a bit, and it's less positive than it used to be. So we compare this. So this is our benchmark now. So we expect that the Australian trade balance should come up at about 1.4 billion. Let's go back to what we were discussing. So I also have a question that says, why does the US let her trade deficit with other countries for such a long time until it had to take drastic action by going to trade war or tariff increases? Those issues are mainly related to both trade and politics. So the issue here is not just that prices that the US imports a lot. It's also a case that the US also faces a large inflow of funds, which is not exactly what we would suggest here. I mean, we would feel that the trade balance of the US is an issue and has been an issue, but it's not that much of an issue as Donald Trump makes it to be. And that is, again, my own personal opinion, so please do not consider it as anything else. So why did the US allow the trade balance to increase? So the answer is that if a currency, so there is a very nice economic theory that suggests that if a country actually wants to have the dominate currency in the world, it needs to run a trade deficit. So in this case, the trade deficit should be a permanent part of that country's agenda. Hence, this is why the US has let their trade deficit increase, although, as we've said, this is not a major point as Donald Trump makes it be. So, moving back to our discussion. Sorry. As you've seen in our HotForex calendar, there is a column named consensus forecast that actually suggests what the forecast for that specific trade balance is. So what happens here is that traders see this information. We've all seen this information. Now we know that the Australian trade balance is expected to stand at 1.4 billion. How do we proceed with that? So the idea is that people tend to discount this information. When I mean when I mean discount, I mean that people say, okay, I have this forecast. I expect that it's going to be, for example, a surplus, but it's not going to be that much of a surplus. So I will put this into the price. So for example, if you're saying that, okay, exchange rates should be, the exchange rate should be at, for example, 1.2. If I have this information on the trade balance, then one could say, okay, if this trade balance is worse than expected, then I would most likely see a small deterioration in the exchange rate. So one would say, okay, if it's now at 1.2, then I would expect it to go to about 118. So many traders will sell before will sell up to a point. So they may not say, I'm selling it big time, but they may say that I'm selling it up to a point, hence the word discounting. They're not factoring in the whole event, but they are factoring in a large amount of this information. So this is why it's called a discounting. So what happens here will be much more clear after this example. So remember that forecasts are just forecasts. It doesn't make sense to say that they are right or wrong. In essence, forecast is just an average of how we expect things to evolve. What this means is that the forecast could vary significantly from the actual data release. For example, if we're expecting a $20 billion trade deficit for the United States, actual numbers may show a 10 billion deficit or a 30 billion deficit. So what this means is that in the first case, the trade balance was expected to be worse than it actually was, while in the second case, the trade balance was expected to actually be better than it really was. So what happens in this case? The answer is that in this case, traders start to adjust their currency positions upon this announcement. So for example, if the trade deficit was less than expected, in the case where it was 10 billion instead of 20, then the USD would most likely see an appreciation instead. Why? Because now we know that, well, we were expecting things, we were expecting that things would have been worse, but they're actually quite improved. So in this case, we see that, okay, we had sold off the currency because we thought things would go worse, but we're now buying it again because we know that things are quite better than we expected. So this should lead to an appreciation of the currency. In contrast, if the trade deficit was more negative than expected, then the USD would most likely depreciate, since the supply of dollars was actually higher than the one anticipated. So remember that the trade deficit, a more negative than expected trade deficit, suggests that more goods were imported than exported, and more goods were imported and exported than what was expected by the markets. Hence, what we will see is that, okay, we expected the trade deficit to be large, but we didn't expect it to be that large. So we didn't discount enough. So in this case, we should observe again a deterioration of the currency. Let's have a look at an example here. For example, in early, I think it was mid-August, consensus forecast anticipated that Japanese trade deficit would stand at 50 billion yen. However, on August 16, actual numbers showed that the trade deficit stood at 231 billion, a huge difference. So notice that the difference between actual and expected was more than 180 billion. So this was more than $1 billion US dollars. What had happened was that exports had increased much less than expected, while imports also increased more than they were expected. So this means that the supply of yen in the market was higher than they expected. How do we understand this? Remember again that if we face a deficit, the supply of the currency is larger than its demand. So remember again that what we said before, if we are importing more than exporting, then we're sending domestic money abroad, which means that a larger demand for this money, a larger supply for this money, exists. So what this means is that if the supply of yen is higher, then the currency should depreciate. Does this hold in the market? Let's see. Let's have a look. Notice here, this is upon the time of the announcement. You will have noticed that I am using an hourly chart, but this could also be observed at the 30-minute chart or even higher frequency one. So look at this. What does this thing say? It says that upon exactly the time of the announcement, the Japanese yen depreciated. So the dollar yen pair shot up here. It actually, the movement was quite large because it moved around 300 pips or 200 and something pips here. So notice a huge difference in the reaction of the market. So market reacted heavily after that. It was not that things were as expected. It's because things, and when I say things, I mean the trade balance was much worse than the markets had predicted. A same situation holds not just for the dollar yen pair, but also for the sterling yen pair as well. So in this case, you can see here that the pair, the yen depreciated again by 45 pips or by 0.19%, which is again a very high, a very large decrease. The same thing holds for the euro yen pair. So again, this increased by the euro exchange rate increased by 52 pips, which is approximately 0.41%. Now notice something here, that this was a rather stable increase. So it shot up and it continued to move around those levels until the following day. The same with the sterling and the same with the euro. Now, a good question would be, why doesn't the yen depreciate the same in each currency pair? So for example, why aren't we observing the same depreciation in the in the dollar yen pair, which was, remember, 0.19%, and the sterling pair, which was 0.19 again, or the euro yen pair, which was 0.41. So the answer is, as you may have already guessed, that the magnitude is mostly based on the other currencies trade balance. So for example, suppose that the euro area actually had as a deficit. So what would that mean is that, well, if the currency has a if the euro area has a deficit, then it would mean that a lot of euros are still out in the market. So most likely the euro area would also have a trade deficit with Japan, but so would we would expect from Japan in this case. So Japan should also have a trade deficit with the euro area. So how does this make sense? So if both have a deficit, then we expect them to have a large deficit with respect to all other countries as well. How does this work? Well, in this case, we say that the deficit, each other's deficit should matter less because both have a large deficit. This is what happened. I'll jumping a point here and moving here in this fourth point. And what we're saying is that in the case of a trade deficit, which was also a result of many other factors, just like the question I received earlier, for example, of why does the US let its trade deficit persist? And for example, in the case of the UK, the depreciation of the pound following the Brexit decision. In this case, we know that if a trade deficit occurs, then we will have a smaller reaction to the trade deficit of Japan, announced by Japan. In contrast, in the euro area, where the euro trades, the euro trade balance records a surplus, this means that the supply of euros was already lower in the market, and hence a larger reaction should be expected. Again, as we've seen, it's all about supply and demand. What we're saying is that if the supply of euros was lower because of the euro area trade surplus, then an increase in the supply of yen would mean that, okay, we already have less supplies of smaller supply of euros, and we have a larger supply of yen, then this should mean that the yen should depreciate by more. So the yen should lose value. But a good question to be asked here is whether the trade deficit is good for everyone. When we say everyone, I mean, does every market or does every instrument get affected the same way with this through this trade balance? And the answer is no, not for everyone. So for example, imagine, and back related to the question I got earlier, imagine that a trade balance is also a sign of how much we consume. So for example, if we consume more, then we would really have a negative trade balance, i.e. a deficit. So if we consume more than we actually produce, then this means that our economy is nevertheless growing, but it's also facing a negative trade balance. The idea is that the domestic economy is growing, So the GDP growth rate should be higher, and hence it needs to import some goods for consumption. Higher imports though means that the domestic goods are also used, right? So we consume so many goods that we actually consume many of our domestic goods, and we still have to import more. So higher consumption means that higher imports mean higher consumption. Higher consumption will essentially mean that the firms who are selling these goods will be gaining more profits. Hence, what we're suggesting is that the value of the companies will increase because exactly of this higher profitability. So imagine if the stock market is already placed at a level where the valuation stands at zero, say for example, 10 times the profits. So 10 times the profits would mean that a higher amount of profits would result into a larger amount, a larger valuation. So if, for example, I have total profits of 1,000 and I have a valuation of 10 times the profits, then the total valuation would be 10,000. If I have a valuation, if now my profits rise to 1,100, that means that with the same valuation, the amount of the valuation should go to 11,000. So what does this mean? It means that the whole of the stock market will also increase. And this is what we observe in the Japanese yen situation. So in the Nikkei, following the Japanese yen deterioration, we observe a positive increase in the Nikkei. So what we're observing here is that prices tend to continue going positive. So what does this mean? Well, it means that again this holds. Now have a look at another chart indicating these changes. So this was from the trade balance of September 18. Again, the Japanese yen actually recorded a deterioration in the trade balance. So what happened here? So let's take different currencies, for example. Now I'm using here the dollar yen exchange rate just for a benchmark, and you actually see that these increases. So the yen depreciates or the yen goes down in value when a negative trade balance is observed. Does this hold for every currency? Well, yes. Let's move here. The Canadian dollar again appreciates with respect to the yen, and the same thing happens with the Swiss franc as well as the Aussie dollar. So this happens because the Japanese yen is actually losing value against all of the currencies. And the same would also happen for the Nikkei. So the Nikkei observes this change in the trade balance and says, well, you know what? Trade balance again is negative. So what does this mean? Well, it means that we're importing more than we're producing. How can this happen? Well, this happens because consumption should be increasing in this country. So if consumption is increasing in this country, then this means that prices, the firm profitability should increase. So if firm profitability increases as a result of a higher, an increased trade deficit, which again results in higher consumption and higher profitability, then the value of these stocks should again increase. How does this translate into stock market changes? Well, you've seen here that we see a large increase in the value of the of the exchange rate. So quite simply, this means that a positive development in the exchange rate should be contrast following a trade balance announcement should be contrasted with the opposite move in the exchange in the stock market. So if the trade balance is negative, then the currency should depreciate, but the stock market should go up. Okay, so what can we take away from this webinar in just one sentence? What we're saying is that a worse than expected trade deficit is usually bad for the currency and good for the stock market. Note that the opposite usually holds as well. A better than expected trade balance result is usually good for the currency and bad for the stock market. When I say usually, I do mean usually. It doesn't always have to be like this. It depends on the country characteristics. What do we mean by this? So, for example, take Switzerland. Switzerland is a heavy exporter. So, its economy is mainly export driven. What this means? It means that higher exports are associated with higher higher firm production, and it means that demand for Swiss goods abroad has increased. So if demand for goods abroad has increased, then what we would be observing is that the profits of Swiss companies should increase. Is that clear? So the idea here is that the amount of if exports increase, for example, it's good for the economy. If imports increase, it's bad for the currency, but good for the economy. So that's the idea. So the trade balance is a combination of the two. Okay. So the trade balance is, remember, is how much we buy from abroad, that is imports, and how much we sell abroad, which is exports. This suggests, again, that if we sell more abroad than we sell in, so if just exports change, then what we're suggesting is that this does not affect the exchange rate by as much. However, if we see that there is an effect, a different effect, for example, if we see that exports increase and imports remain the same, then it means that both the currency and the exchange rate and the stock market, will appreciate. So better than expected exports are good for growth. In other words, if imports are increasing, then this is good for the stock market but bad for the currency. Okay, so we need to notice the difference between the two. So the question is, why does the trade balance move, and when would the trade balance be positive? This is the answer we've just given. So trade balance again is made of imports and exports. If imports rise, then this is good for this is usually good for the stock market, and this is usually bad for the currency. However, if exports rise, this is usually good both for the stock market and for the currency. Notice a very, very important point. Other economic announcements could also take place at the same time and could have an impact on the exchange rate to either the same or the opposite direction. So imagine that at the same time, we have an announcement that growth has actually declined or has actually increased, for example, in Japan. So increased growth combined with higher with a larger trade deficit could mean that these two have an opposite effect. So negative trade deficit due to imports or to less exports means that this should continue to this should be bad for the currency. In contrast, strong economic growth suggests that this is good for the currency. So the two will cancel each other out. But the extent at which they move cannot be predicted in most times. So we need to pay good attention that when we observe news, we observe them without any other pieces of information being affected by this. So questions, please ask your questions on anything you didn't see, or anything you would like to ask, or anything else you would like to see in this analysis or in future analysis, or something you found was not clear enough. So please share them with me. I would be delighted to answer any questions you have. So either that was completely clear, crystal clear with what I was saying, or something was not at all clear and I get zero questions basically. So okay, if there are no other questions, so let's move to other things. So thank you, Hamed, for saying it was clear. But please do ask questions if anything confused you, or if you're unclear, or do not have the holistic view of how things would work. So remember that we have the HotForex app, and you can fast track everything to anything you want in Forex. And stay with us, because following my trade balance and exchange rates webinar, we have Otto tomorrow presenting on an interesting point on how the Bollinger Band works. Hamed asks whether I have a PDF of the webinar. I do not have a PDF of the webinar, but I'm pretty sure we can arrange that. In addition, there is also a post on the HotForex website. You will also get the recording of the webinar, so you will be able to hear us talk. So I've also have this post on the HotForex analysis website. So these exchange rates and the trade balance is a post where I follow through everything here, and I give you the example of how things moved. I have also the follow-up example, which is here. So trade balance and currency markets, another example. And this is all there is. I will try to send everything we have to you, Hamed. If there is an issue, I'll send it. We'll send it through webinars. So for next, then we have how do Bollinger Bands actually work. We've got live analysis with Stuart on the 9th of October. Again, Stuart was gonna give a very interesting webinar on Fibonacci with Otto on the 10th of October, with Otto providing an overview of how support and resistance levels work, and Andrea giving live analysis on the 16th. Andrea is also presenting a very interesting webinar on the 17th of October, which is an introduction to Elliott wave analysis. So Elliott wave is widely used, and it is a very, very interesting technique in technical analysis. Otto will provide technical indicator basics, with Andrea giving the live analysis on the 23rd of October, while I will be doing another webinar regarding the carry trade. So if you've been following my posts, you need to understand how the trade balance more or less works, as well as understanding, and we will go through how the carry trade can be positive when it comes to overviewing this point. So the carry trade will go on with me. And interesting point again by Otto, he'll be presenting an overview of scalping strategies on the 25th, and Stuart will be doing a very interesting live analysis and webinar. So he will go through the mind games of trading, which will provide a very good insight regarding trade psychology. So if you want more analysis, please visit our website at analysis.hotforex.com, and you will have an update on how you will see our updates on a daily basis. Basically, we offer an in-depth review of the major economic issues. So for those who have never been on our website, this is our website. So at the moment, we have the fourth quarter outlook for 2018 following our seminar, our webinar last week. You can actually subscribe here on the daily market analysis we offer, and be up to date with every development in the world, in the forex market. So again, before I close, please let me know if you have any more questions. Feel free to ask me now. Okay, so I'm guessing there are no more questions. If any questions come up, please send me an email at webinars at hotforex.com, and Stuart, Andrea, or I will be replying fast back to you. So thanks everyone for being here. Thank you very much for listening to me, and be safe, trade well, and trade safely as well. Do your risk management, guys. So very nice hearing from you. Thank you very much, and we will talk again soon.